Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, currency analyst at MUFG. It's Monday, July 19th, 2021, and in our preview of the week, we're discussing the key themes for the FX financial markets. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only. So good morning, Lee. And what are you expecting from the ECB policy meeting this week?
Hi, morning, Una. Yeah, I think expectations have been raised ahead of this week's ECB policy meeting, following the comment we had last week from President Lagarde, where she kind of highlighted to investors that this is an important meeting. It's obviously the first ECB policy meeting since they announced the changes to their monetary policy framework. So I think at the very least, we're expecting the ECB to update their forward guidance to incorporate obviously clearer references to the new symmetric 2% inflation target, and also to signal obviously a greater tolerance to allow inflation to modestly overshoot their target, at least for a temporary period going forward. So that kind of updated forward guidance should, in theory, signal that the ECB has some more leeway to keep loose policy in place for longer. But I think if that's all we get, I think the market would be left disappointed. Really, I think what the market's looking for is also some policy action as well to try and boost the credibility of this new policy framework. So on that front, we're looking for the ECB potentially to make some adjustments to their quantitative easing programs. So obviously the first quantitative easing program is the PEP program. There is some potential for them to announce that the faster pace of purchases could continue beyond the third quarter into year end, or potentially as well they could also look at potentially delaying the planned end date for that PEP program. At the moment, they're signalling that could come to an end in the first quarter of next year. There is some potential there that they could push that back further into 2022. And then secondly, there's also the asset purchase program as well, which is currently purchasing 20 billion euros per month of assets. And under the current plans, that's generally expected to continue beyond the end of the PEP program until the ECB has more confidence that their inflation objective is met and that they're getting closer to raising rates. So on that side of things, we're looking for them potentially to maybe beef up that asset purchase program once the PEP program rolls off, in a way to try and reduce the kind of drop off in the overall pace of purchases once PEP ends. So they could potentially signal some willingness to increase the amount of asset purchases under that APP program from 20 billion and make that higher once PEP comes to an end. So there's certainly a number of ways that they could signal kind of greater willingness to maintain looser policy from next year onwards to continue to support the recovery. But as always, there's also the risk, obviously, of disappointment. The ECB may feel that they'd rather wait a couple of months until the September meeting before they announce any further policy changes. So, in terms of the impact on the euro, we would expect it to kind of remain under some selling pressure ahead of this week's ECB meeting, given the possibility of some further policy action from the ECB. Obviously, we're in a kind of environment right now where markets are still becoming more concerned over the kind of global growth outlook. And that is certainly favouring the outperformance of safe haven currencies like the dollar, yen, and Swiss franc. And generally, in these kind of risk-off periods, the euro also tends to trade relatively well. So while we would expect the euro to come under some selling pressure still against the dollar, yen, and Swiss franc, I think it should continue to kind of hold up better against the more high beta currencies such as commodity currencies and the pound and other emerging market currencies, even if the ECB does deliver a more dovish policy message on Thursday.
And have recent comments from the Bank of England officials caught your attention, Lee?
Yes, I think certainly the comments that we heard from MPC member Ramsden and also Saunders at the end of last week certainly struck a more hawkish tone than we've seen recently from other MPC members, signalling certainly much more discomfort over the upside risks to inflation, signalling that they are seeing increasing risks that we could see headline inflation rise towards 4% going forward, and that is making them more uncomfortable about maintaining the current kind of extremely loose policy conditions that are in place. So certainly the comments there from both officials do suggest a higher risk, potentially as early as at the next MPC meeting in August, that the Bank of England could consider starting to rein back some of this policy stimulus. So the most obvious choice would be to potentially slow down the pace of the quantitative easing program, or even signal that they could bring an end to that QE program earlier than their current plans at the end of this year. And obviously, if they were to do either of those steps, then that would encourage the market as well to bring forward expectations for rate hikes into earlier in 2022. So I think those developments are certainly putting upward pressure on short-term yields in the UK, which we think over time will be supportive and will encourage a stronger pound. But like I said, we're in an environment right now where we're in a kind of risk-off phase in markets, and the pound tends to generally underperform when you have kind of risk-off periods, seen as more of a kind of high beta G10 currency. So far, we haven't really seen kind of a strong upward pressure put on the pound from these hawkish MPC comments. But we do think if the kind of market certainly settles down and stabilizes and becomes less concerned over growth, then at that point, if expectations for tighter Bank of England policy continue, then that could certainly see the pound start to strengthen more notably as we go into year end and into next year. Apart from the Bank of England, though, it's not just obviously the Bank of England that have been more hawkish recently. Other G10 central banks as well have kind of become more hawkish, such as the RBNZ, as we saw just recently. They kind of brought an end to their QE program much more prematurely than the market had anticipated. And that's certainly led to the market to price in a couple of rate hikes from the RBNZ in the second half of this year. But similar to kind of pound price action, given these kind of global growth concerns are very much in the market's focus right now, the Kiwi as well has kind of failed to really kind of rally on the back of yield spreads moving in favour of the Kiwi. But like I said, similar for the pound, we think eventually if the kind of growth concerns starts to ease, then we would expect the New Zealand dollar to kind of benefit more going forward from the hawkish developments from the RBNZ.
Thanks very much for that insight, Lee. Have a great week, and we'll speak to you soon.
Great, thank you. Good to speak to you as always.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research Team.